So the ratio I'll be covering is the current ratio, which is total current assets over total current liabilities. So I've taken the data from the past 3 trading years of after you, and I've labeled the total current assets, total current liabilities, and their current ratio. So by the end of 2017, after you had a current ratio of 6.63 to 1. However, by the end of December 2018, their current ratio had decayed all the way down to 4.49 to 1. But by the end of 2019, which is that trading year, they managed to slow down the rate of decay, and now they're currently sitting at 4.4 to 1. So for the current ratio analysis, so after you has well surpassed the optimal current ratio, which is 2 to 1, and it is even more than double that. And this is great for after you because they can easily pay off their short-term debts. However, the current ratio has been worsening over the past 2 years, as we saw in the the table earlier. And the huge drop from 2017 to 2018 can be explained by the fact that their total current assets dropped by 30 million or so, and their total current liabilities went up by 33 million. And the main things responsible for this are their trades and other payables, which is part of their total current liabilities, that jumped up by 23 million. And their current investments, which is part of their total current assets, that decreased by more than 60 million. And by the end of the 2019 trading year, they managed to get their total current assets back up to 549 million, an increase of approximately 5.22%, which is awesome because it slows down the rate of decay. So based on this, we can assume that after use total current assets isn't the main issue. However, after a careful analysis of their balance sheet, after use main problem is their total current liabilities. That has been increasing ever since the end of 2017. Their trades and other payables have gone down since 2018, but are still 20 million higher than the ones from 2017. Another source of concern for after you is their income tax that keeps increasing. It has gone up by more than 10 million since 2018. After U's other current liabilities also saw an increase of around 8 million since the end of 2018. So how can we fix this? So to solve the total current liabilities problem, after you can decrease the amount of dividends they give to their shareholders. This should decrease after use trades and other payables, as dividends is part of that. But then again, the shareholders will definitely not be happy about this, as they're getting less money, and this could easily pull down their share price. Another thing after you can do is funnel their money into a shell company. Doing this would definitely decrease their tax income. However, this is extremely unethical and could lead to boycotts, which is PR hell. It could also lead to a decrease in brand image and reputation, and stock price dropping, and many more. Another remedy they could use is to have someone in their financial team identify the cost of their other current liability problems. And they could fix this and even lead to better cash flow.
After you finance accounts of asset ratio, so after you has well exceeds the optimal quick ratio 2 to 1. So this means that it is great as the after you can easily pay off their short-term debt. But however, this quick ratio has been worsening over the past 2 years as 2018 and 2019. Before I start the financial on the table, so let's see that in generally the business target need to higher ratio, even though project the present accounting recommended a ratio of at least 1 to 1, but for after you had higher than this, so these are the liquid fund available without selling the stock. However, caution must be taken because too high, and acid test ratio suggests that the company is holding on to too much cash. So this could be used more effectively in the company or invest in interest-bearing security such as the bank saving account. And I will move on to the 2017. So the huge drop from 2017 to 2018 can be explained that by the fact that their total current ledger dropped by of approximately 30 million, and their total current liability rise up around 33 million, and by the end as 2019 they managed to get their total current assets back up to 549 million, and slowing down the rate of their decay. Based on this, we can assume that After's total current assets has isn't I mean like their total current assets is the main issue. So in contrast, After's main problem is their total current liability that which is like there has been increasing since the end of the 2017 trading year. And the possible strategy to improve their acid test ratio, I recommended two choices. Is the first one is increase sale, but I think this is not efficiently enough to after. So basically, this will help increase the company's cash in hand. However, this might have the added cost of advertising or other promotional effort. But other hand, I think that the reducing current liability is a direct problem to solve their problem. So this means that like paying off short-term loans or overdraft and trade creditor will reduce the current liability that needs to be covered with the added advantage of saving on interest charge.
Gross profit margin for after you, which can be found by gross profit divided by sales revenue times 100. So I've taken the samples from 2019 and 2020 after you income statement, which states the sales revenue, the cost of goods sold, which I take the sales revenue divided by 8 minus cost of goods sold to get gross profit, and then I divide it by sales revenue and times 100 again to get the gross profit margin percentage. As you can see, between 2019 and 2020, there was a 3%, roughly 3% drop in gross profit margin, meaning that the sales has substantially decreased since after you sales are a big amount of product. Although going to net profit margin, which can be found by net profit divided by sales revenue times 100. I've also taken the sample from the same year, which furthermore states the expenses and the net profit, which I calculated by taking gross profit minus expenses. And as you can see here, the net profit margin decreased from 25.4% to 8.75%. This is a significant drop in their net profit. This may be due to the decrease in sales revenue, which decreases by 60 million baht, resulting in a wider gap in net profit margin, since the expenses stayed the same, although they haven't saved as much.
Moving on to the return on capital employed. From the formula given, we have calculated it for 2019 and 2018 from the data provided in the balance sheet. And as you can see, for 2019, it comes out to be 17.21%. And for 2018, it comes out to be 4.74%. As you can see, it's major difference from between the return on capital employed from 2019 and 2018.